Welcome back. We are in week 19 of our webinar series. Tonight, we are going to talk about buyers' preferred lenders and all the things that go into that. So we want to go ahead and get started and jump right in here. You know, I appreciate you guys' time and I don't take it for granted that you're here. So let us get right on into it. I am Daphne Brown, the broker owner of Beyond The Home Realty. And we started what we refer to as Wednesday webinars at the beginning of this year because we know that there are lots of questions in regards to real estate for buyers and sellers, buyers of townhomes, residential, land, commercial, whatever. We wanted to just make it this a safe space to learn what you need to learn, educate yourself, but then also to be able to ask questions, but break down real estate in the simplest forms, right? Some things that you can sink your teeth into and really understand. So that was the purpose of this. And we do this every Wednesday at 7 p.m. and we get started on time. One thing I always tell my clients is this: real estate and mortgages do not have to sound complicated, and they don't have to be complicated. A lot of people just try to sound very smart, and what they're doing is just confusing people. So my goal today is to break down this in plain English so that you walk away feeling educated, empowered, and confident before signing anything with a builder. So by the end of this session, you're going to understand what a builder's preferred lender is, why builders encourage buyers to use them, the advantages and disadvantages of using a builder's preferred lender, the red flags to watch for, and how to compare loan offers the smart way. This webinar is not about telling you what lender to use. It's about helping you make informed financial decisions. A preferred lender is simply the mortgage company that the builder recommends or works closely with. In many cases, they're sometimes really close to the sales counselor or at their fingertips, where the sales counselor can just pick up the phone and call them and they are ready. Sometimes buyers make the mistake of assuming that they have to use the lender that the builder is telling them about. And that is absolutely not true. You do have options, and you as a buyer are allowed to shop around and compare lenders. Here's something many buyers do not realize. Large builders like Lennar and D.R. Horton often own their mortgage companies. And that means they make twice the money, right? They are making money twice. First, from selling the home, and second, from financing the loan. Now, that does not automatically make it a bad thing, okay? But it does mean that buyers should slow down and compare options carefully instead of assuming that the builder's lender is automatically the best deal. Builders push their preferred lender for three main reasons. First, increased profits. Second, smoother transactions because everyone works together internally. And third, competitive marketing. Those large signs advertising $15,000, $20,000 towards closing costs, they're designed to attract buyers emotionally at the point of sale. Now, let's be fair. There are some real advantages in some cases of using the preferred lender. Builders often offer thousands of dollars towards closing costs, lower interest rates, faster closings, and streamlined paperwork. For some buyers, especially first-time buyers, these incentives can genuinely help make home ownership possible. Many builders even negotiate something called forward commitments. And basically, they lock in large pools of mortgage rates ahead of time at one time. And this is what allows them to offer lower introductory rates. And yes, that can absolutely save buyers money monthly. But the important thing is understanding how long those savings will last. Now let's talk about the downside. Sometimes buyers focus so heavily on the upfront incentives that they ignore the long-term costs. So you may see higher lifetime interest costs, hidden lender fees, or less flexibility if problems arise. And that's why we never look only at the shiny incentive number. One common example is the 2-1 buy down. Your rate is reduced the first year, reduced a little less the second year, and then the third year it jumps significantly. So yes, the payment does look attractive up front at first, but buyers need to prepare financially for the future increases in their payment. So now let's do some math. Let's look at a real example. Imagine a buyer receives $15,000 towards closing costs on a $400,000 home. Sounds amazing, right? But if the interest rate is even slightly higher long term, the buyer could end up paying tens of thousands of dollars more over the life of the loan. And that's why smart buyers compare total cost, not just upfront savings. Builders are excellent marketers, and many deals look incredible on the surface, but you got to peep underneath. And this is why buyers need someone in their corner helping them evaluate the entire financial picture, not just the headline incentive, not just what's shiny and bright. This is important. You do not have to use the builder's lender. I'm going to say it again. You do not have to use the builder's lender. It's not a must. However, if you use your own lender, we call those outside lenders. If you use your own outside lender, you may lose some incentives. But that's where strategy comes in, and that's where having an experienced real estate professional matters. So right now, what we're seeing is if we have a buyer that is adamant about using their own lender, either because it's their banking, institution, that's where they do their banking at, or they've had previous mortgages with this lender, that is fine. What we do so that it is clean and we're not like muddying the waters, we ask that outside lender to take them all the way through underwriting. So get them not pre-qualified, but pre-approved before we go into the builder. So again, it's strategy. And we're finding that that's working out a lot because there is less risk for the builder in doing it that way. And we're still able to get some of those incentives. All right. Sometimes buyers lose part or all of the incentive by bringing an outside lender in. And again, I told you, I just gave you our little secret. Ain't no gatekeeping over here. That's what we do. If we're using an outside lender, we are getting them all the way pre-approved into an underwriter before. So it's more than a piece of paper saying they're approved. It's the outside lender has checked their bank statements, they've sourced their down payment, they've checked their employment, they have their pay stubs, and they've checked their credit extensively. So we're still able to get some of those incentives. Now, if you are losing some incentives, that doesn't mean that your lender that you're focused on using is a bad choice. Because sometimes the outside lender still ends up cheaper overall despite losing the incentive. And that's the important thing. And that's why we go line by line to compare with multiple lenders. All right. This is where buyers need to slow down and again, compare line by line because sometimes the builder's lender appears cheaper up front, but hidden fees, higher rates, or long-term costs tell a different story. Always compare the loan estimate carefully, and that is where we come in helping our clients. Yes, buyers can usually switch lenders early in the process, but timing does matter. Once appraisals and underwriting move forward, changing lenders can create delays or complications, and that's what we don't want. And this is why I always recommend discussing changes with me up front before making a decision like that. But if we do it up front, we can absolutely change lenders. Is it legal for builders to try to pawn their preferred lenders off on buyers. It is. It's completely legal because you know that you don't have to use their lender, right? But yes, getting back to the question, it's completely legal for builders to encourage buyers to use preferred lenders. They're just encouraging you. They're not, and they're encouraging you by giving you money towards closing costs. They're not saying you have to use this. The key requirement in all of this, though, is disclosure. Builders must clearly disclose their relationship with the lender. Now, here are some red flags. Be cautious if a sales rep or anyone for that matter, the preferred lender, anybody says, you have to make a decision by Friday. That's a red flag. If they're telling you, you have to use our title company to, red flag. If they say, the rate is locked, but they've offered you nothing in writing, red flag that thing. Or if they refuse to provide fees clearly. Pressure is never a good sign in a financial transaction. One of my favorite buyer strategies is what I call the 3 lender rule. So always get estimates from at least 3 lenders. Compare interest rates, fees, monthly payments, and long-term loan costs. Then choose the option that best supports your financial goals. And when reviewing loan estimates, pay attention to the interest rate, the total closing costs, the monthly payment, and the long-term projections. Sometimes the cheapest monthly payment today becomes the most expensive loan tomorrow. Here are some smart questions every buyer should be asking. What is the actual interest rate? Is the rate locked? How many fees are included? And who owns this lender? Never feel intimidated asking questions about your money. I'm so cheesy. All right. Now, to be clear, sometimes using the builder's lender is the right move, especially if the incentives are very substantial, if the closing timeline is tight, or if the overall financial package genuinely makes sense. But the key is making an informed decision instead of an emotional one. Here are the biggest mistakes that I see buyers make: letting themselves get rushed, failing to compare quotes, accepting verbal promises, and signing paperwork without reading carefully. This is one of the largest purchases of your life, so slow down and make sure you're protected. All right, so here's your action plan. Step 1, request the affiliated business arrangement disclosure. Step 2 is get the builder's lender's loan estimate. Step 3, compare carefully with outside lenders. And of course, if you're working with me, I'll help you review those numbers as well. One thing I offer my clients is a free incentive analysis. I'll help review the loan estimates, the hidden costs, the incentives, and outside lender options. My goal is helping buyers maximize savings while protecting their long-term financial health. For those of you who may not know me, I am Daphne Brown, the broker owner of Beyond The Home Realty. I specialize in helping buyers navigate through new construction, resale homes, land purchases, and everything in between. My goal, though, is always education first because educated buyers make confident decisions. Anybody can show you a beautiful home. But if you just see a beautiful home and you're like, yeah, sign me up, and you get signed up and you move in the home and now your payment balloons or you don't know how to protest your taxes, yeah, that's crazy. So I like to educate. We have so many resources available to our clients on new construction, new homes. We have cheat sheets. We have calculators. We have an insider's guide, like so much from start to finish on everything that you should be looking for in a new construction home, how to find the home that you love, how to prioritize the things that you need, how to prepare for the payment recalculation, all of the things we help our buyers with, and we have resources for all of those new construction items. Now we're going to incorporate rate buydowns into this webinar as well, just as a supplement because again, we want you guys to get everything that you need to get so you understand real estate in its fullest. So we're going to start here. And the reason why we're talking about this right now is because the market has shifted and we're seeing things like this every day. Buyers are feeling priced out. They've been watching rates, watching prices, and they're scared to pull the trigger because their monthly payment feels too high. And on the other side of that, sellers are feeling stuck. The home that they're in, they're wanting and thinking about selling it, but they're seeing that homes aren't moving the way that they used to. And sellers who have made the decision to put their home on the market, they don't want to drop the price because they're chasing comps from 2 or 3 years ago. And so rate buydowns are the bridge between buyers and sellers who feel like this. Rate buydowns give the buyer real monthly relief without forcing the seller to cut their price. And once you understand how this works, you'll see why it's the conversation I'm having on almost every deal right now. So let's start with the basics. What actually is a rate buydown? It's simple. A rate buydown is when someone pays money up front at closing to lower the mortgage interest rate. And when you lower the rate, you lower the monthly payment. Now, here's what's interesting, that someone who pays for it doesn't have to be the buyer. It can be the buyer, but it can also be the seller, or it can be the builder. We'll get into who pays in a minute, but I want you to hold on to that because that is what changes everything. Okay. So it could be the buyer, the seller, or the builder. Here's what I want you to think about when it comes to a buy down. You're prepaying for future savings. You hand over a check at closing, and in exchange, your monthly payment goes down, either for a year, for a couple years, or for the entire life of the loan, depending on which type you choose. It's trading cash today for lower payments tomorrow. And when it's structured right, especially when the seller or builder is the one writing the check, it can be the smartest financial move that a buyer can make. Buy downs come in two big categories. I want you to keep this straight in your head. Category one is temporary. And with a temporary buy down, your rate is reduced for a set period of time, usually 1, 2, or 3 years. Sometimes it could go up to 5. And then it'll go to the full market rate. Category two is permanent. And with a permanent buy down, your rate is reduced for the entire life of the loan. 30 years if it's a 30-year mortgage, 15 if it's a 15-year mortgage, 20 if it's 20, you get it. Whatever loan term you decided to get when you got the mortgage. If it's a permanent buy down, it'll be for the life of that loan. So now we're going to get into looking at the three most common structures: a 2-1 buy down, a 3-1 buy down, and permanent points. So let's start with the most popular one in today's market. And that is the 2-1 buy down. This is the one you're going to hear about the most. And here's how it works. In year one, your interest rate is reduced by 2%. In year two, it's reduced by 1%. And starting in year three, it goes back to the full note rate for the rest of the loan. So let me give you a quick example. Let's say the note rate is 7%. And with a 2-1 buy down, year one, you'd pay 5%. Year two, you'd pay 6%. And year 3 through 30, you'd pay the full 7%. This option is best for buyers who think their income is going to grow, or buyers who are planning to refinance once rates come down. It gives you breathing room in early years of home ownership when money tends to be the tightest. Now let's get specific. Who's the perfect buyer for a 2-1 buy down? Number one, buyers expecting income growth. So if you're a new doctor, a new attorney, someone on a commission ramp, or you've got a clear to close, a 2-1 buy down gives you lower payments now while your income catches up. Number two, families who need early relief. Maybe you're moving, you've got new daycare costs, you need to furnish the home, your savings took a hit on the down payment. A 2-1 gives your budget some breathing room in those first couple of years while you get settled in. But I want to be honest with you. A 2-1 is not for buyers who are stretched thin, even at a discounted rate, because year three is coming and that full payment will show up. If you can't afford year three, this is not the right tool for you. We'd look at something a little bit different. Now let's look at the bigger sibling, the 3-2-1 buy down. Same idea, but stretched over 3 years. Year one, your note is reduced by 3%. Year two is 2%. Year three, 1%. And year four onward, you're at full rate. So using the same 7% example, with the 3-2-1, you'd pay 4% in year one, 5% in year two, and 6% in year three, and 7% starting in year 4 through 15, 4 through 30, whatever you signed up for. You see this option most often on new construction homes. Builders love it because it lets them advertise really attractive monthly payments without lowering their list prices. So if you're shopping new builds in our area, ask about the 3-2-1. There's a good chance that it is definitely on the table. Now let's talk about the permanent option. A permanent buy down works through what we call discount points. 1 point equals 1% of the loan amount. And a rule of thumb is 1 point typically lowers your rate by about 1/4%. But that lower rate stays in place for the life of the loan. So let me give you a quick example. If you are borrowing $300,000, one discount point would cost you $3,000. And that might take your rate from, say, 7% down to 6.75% for the full 30 years. This option is best for homeowners who are planning to stay in the home long term. We're talking 7 years or longer, because that's typically how long it would take for the monthly savings to pay back what you spent on the points up front. Anything shorter than that, and the math normally don't math. Okay. Let's talk about who pays for it, because here is where it gets really interesting. And this is the question that changes the whole conversation. Who actually writes the check for the buy down? Here's one thing that most buyers assume. They assume they have to pay for it, and they don't. There are three possible sources, actually: the buyer, the seller, or the builder. And in today's market, seller paid and builder paid buy downs are way more common than buyer paid. So if you're a buyer, this is something you absolutely need to ask about. And if you're a seller, this is a strategy you absolutely need to understand. And let me show you why. Sellers, listen up, because this slide is just for you. A seller paid buy down lets you attract buyers without cutting your list price. And this is a huge deal, because when you drop your price, you're not just hurting your own equity, you're hurting the comps for the entire neighborhood. Every house on your block just got a little less valuable on paper. But when you pay for a buy down instead, the sales price on record stays right where it is. Your neighbors are happy, your comps are protected, and the buyer still walks away with the lower monthly payment. It's a win-win. And on the next slide, I'm going to show you that the math proves it. This is the comparison every single seller needs to see. Let's say you've got $10,000 on the table. You can either drop your price by $10,000, or you can use that $10,000 to fund a buy down for the buyer. If you drop the price by $10,000 on, say, a $350,000 home, you're only saving the buyer about $60,000 or $70,000 a month on their mortgage. That's it. But if you take that same $10,000 and apply it to a 2-1 buy down, you can cut the buyer's monthly payment by $300, $400, even $500 a month. Same $10,000, same cost to the seller, same final price on record, but a dramatically different impact on what that buyer feels in their bank account every month. That is why this strategy works so freaking well. Now let's talk about builders for a second. If you've driven through a new construction community lately, you've probably seen signs advertising buy down incentives. There's a really specific reason builders love this tool. Builders need to move inventory, but they can't just lower their base prices because if they do, every buyer who closed in the months prior, they're going to be upset because they paid more than, right? And the appraisals on the whole community will take a hit. So instead, builders offer buydowns because this allows them to advertise lower monthly payments. They protect their base prices and the community values stays intact. Ask me, or if you have another realtor, ask us because part of our job is knowing which builders in our area are currently offering these incentives and which lenders they're paired with. This is the kind of information that saves my buyers thousands of dollars. Now that you know what a buy down is, the types, and who pays, the bigger question is when does it actually make sense to use one? Three green light scenarios. First, if you're expecting rates to drop. If you believe rates will come down in the next year or two, a temporary buy down bridges that gap until you can refinance into a permanent lower rate. Second, if your income is growing. If you got a clear path to making more money, the temporary relief lines up perfectly with your financial trajectory. And third, and this is the easiest yes of all, if the seller or the builder is paying for it. If someone else is footing the bill, you get all the savings with none of the upfront costs. And so that makes that a no-brainer. Here's the flip side of it because I'd rather talk you out of a buy down that doesn't fit your situation than push you into one that costs you money. Three scenarios where you should not do a buy down. First, if you're planning to sell quickly. If you're not staying in the home long enough to recoup what was spent up front, it's a waste of money. Second, if you can only afford the temporary rate. If you're using the buy down rate just to qualify on paper, but you can't actually handle the full payment when year three hits, that house is too much house. So then we would need to look at a permanent buy down or a different price point. And third, if it's just an unnecessary cost. If you're planning to refinance in 6 months anyways, you're paying for something you're not going to use. That money is better off in your savings account. Now I'm going to share the most important thing I'll share tonight. So grab a pen because this catches people off guard all the time. Lenders qualify you at the full note rate, not the buy down rate, the full rate. So even if you're getting a 2-1 buy down and you're going to pay 5% in year one, the lender is going to make sure you can afford the 7% payment from day one. They have to prove you can handle the payment when the buy down ends. This is actually a consumer protection. It's there to keep buyers from getting into homes that they truly can't afford. But what it means for you is this. When you're budgeting for this home, budget for the full rate from day one and treat the buy down savings as an extra bonus. Put the extra money into savings or use it for things you need around the house. Don't build your lifestyle around the temporary payment because year three is coming. All right, let's put real numbers on all of this. Here's our scenario. A $350,000 home. The buyer puts 10% down, so we're financing $315,000. And we're going to apply a 2-1 buy down to that loan. This is a really typical scenario in our market, whether it's a first-time buyer or somebody moving up to their next home. Here's how the payment breaks down. In year one, with the buy down in place, the monthly payment drops significantly. We're talking real noticeable savings that the buyer feels the moment they make the first payment. In year two, the discount is smaller, but still manageable, still meaningful. And then in year three, the payment goes to the full amount, which remember, the lender has already confirmed the buyer can afford. So all the savings in years 1 and 2, that's pure cushion. That's money that goes into the buyer's pocket while they get settled. On the next slide, we'll show you the exact dollar figures. Here are the actual numbers. In year one, the buyer saves approximately $4,860. That works out to about $400 a month, money that stays in your bank account instead of going to the mortgage company. And in year two, they save another $2,480. That's roughly $200 a month. Add those 2 years together, and you're looking at over $7,300 in real savings. And here's the kicker: in most cases, this money is coming out of the seller's pocket, not the buyer's. $7,300. That's a year of car payments. That's a fully funded emergency reserve. That's a chunk towards new flooring or a backyard project. This is real money in your pockets. So, for 1 second, let's come back to the seller, because this is one of the rare strategies in real estate where everybody wins. The buyer wins because they get significantly lower monthly payments without dipping into their savings. The seller wins because the full sale price is preserved on record. There's no price reduction sitting in the public record. The neighborhood comp stays strong, and the listing becomes way more attractive on payment terms, which usually means a faster sale. Even the neighbor wins because their comps are protected too. This is exactly why I bring this strategy to every single seller consultation that I do. Every Beyond the Home Realty client deserves to know that this option exists because it changes outcomes. Before we wrap up, I want to share the 3 mistakes I see buyers make most often when it comes to buy down. Avoid these. Mistake number 1: assuming the lower rate is permanent. Temporary buy downs are just that. They're temporary. Year 3 is coming, so plan for it. Mistake number 2: not budgeting for the payment jump. Set up an automatic savings plan during year 1 and year 2 so that when the full payment hits, it doesn't catch you off guard. Practice paying the full amount even when you don't have to. And mistake number 3: paying for a buy down you don't actually need. If you're planning to sell or refinance soon, the money is better spent somewhere else. Always look at whether it actually fits your goals. How do you make sure that you're getting the right buy down for your specific situation? Well, you're going to ask the right questions. It's simple. Here are 3 questions to bring with you when you're talking to your lender. The first question: what temporary and permanent buy down programs do you offer for the loan type that I qualify for? Now, if they start hemming and hawing on that one, that's a red flag. Question 2: what's the upfront cost of each option and what's the break even point in months? You need real numbers, not vague answers. Question number 3: can my seller pay for this as a concession? And what's the maximum contribution my loan type allows? Because every loan type has different rules, and you need to know what you are working with. If your lender can't answer these 3 questions clearly, you need a buy down friendly lender. And the good news is, I know who those lenders are in our market. So just reach out to me and I will connect you. Okay, we're almost done. So don't just listen tonight. Do something with this information. And here are 3 action steps. Step number 1: get pre-approved with a buy down friendly lender. Pre-approval is your foundation for everything else. If you don't already have one, that is the first move. Step 2: pick 2 or 3 homes you actually love and run the numbers with the buy down applied. Have the lender run those numbers. That math is going to surprise you. And step 3: book a call with me. We'll sit down and talk through seller paid buy down negotiation on the specific homes that you're considering. That's where I really earn my keep, at the negotiating table. Thank you guys so much for joining me tonight. Remember, I'm Daphne Brown with Beyond the Home Realty. I service Brazoria, Matagorda, Fort Bend, and Harris County, any of the Houston suburbs. And I want you to know that whether you're buying, selling, or just trying to figure out the right move in this market, I'm here and I am always ready and willing to enable you to find your way home. Till next time, bye-bye. Don't forget, you can always check out the full playlist here of all of the past Wednesday webinars.
My